The US-China trade war has finally lived up to its name. The only question that now remains is to what extent will regular monetary policy be able to counteract the severe and hot-off-the-press trade dispute revelations? Hello guys and welcome back to World Wild Economy. So first off, I'm going to just head right into the indices recap. So this week overall has been, it was fairly decent. It was actually kind of average, slow moving, but until Friday just this week. So essentially the S&P 500 fell 2.5% in and around that area this week. Nasdaq Composite fell in the regions of 3.2%. And the WIG 20, again the 20 biggest companies in Poland, was up 0.8%. So I'm very happy that it broke the streak of losses. But I'll get on to why that shouldn't, keep me satisfied for a very long time because of the news that I'm going to get into just in a few seconds. So first off, I'm going to start off with the news and headliners. So I've actually got one bigger topic for today, which a friend had recommended for me to have a look at, and it's a McKinsey study on the signs of stress in the Asia financial system. I'm actually going to make a standalone video on that later this week, where I'm going to be covering the study in a bit more depth because there's a plethora of information there which I think people should know, especially investors, and just kind of, I'm trying to build a know-how of various financial systems, especially in emerging economies. But for today, for now, I'm just going to show you kind of what the study entails, and essentially, like I said, just kind of show you what it looks like. So for those of you watching or at least listening, it's a few page long case study by McKinsey and Company, and essentially I'm just going to call out some exhibits or graphs and diagrams that they have. So corporates across most of Asia are under significant stress to service debt obligations. Significant share of stressed debt are held by energy, industrial, and utility companies. Corporate bond markets are large and have deepened materially only in select markets. Rising risk costs, etc., and so on and so forth. There's a few more of these that I'm going to be covering. Like I said, there's just a crazy amount of information here, and I really want to dive deeper into this. So I'll make a 10-15 minute long video that I'm going to be posting later this week. But for now, you can definitely check out the study for yourself. But at the same time, like I said, I will be analyzing this and kind of digesting all of this so that essentially you guys get the information that you need to improve your decision making and essentially help you with investment decisions, or just, like I said, building a know-how of the macroeconomy, the worldwide economy. Worldwide. I always messed this up. But yeah, moving on, I'm going to be talking about two news stories today, which are very, very interrelated. But essentially, the first news story was going to be the minutes, in other words, the kind of recap and consolidation, of July's meeting of the Federal Open Market Committee in the US. So that's a committee which talks about and looks at monetary policy within the US. So that's interest rates, money supply, etc., different regulations. But actually, after getting out of bed today, and when I was reading the news, information came out 10 hours ago at the time I was reading it. So now it's been a bit longer, but it was essentially 1 a.m. here in Poland. So obviously it was a few hours back in the east and west coast in the US, east and west coast in the US, so that they could essentially react to this. But essentially what happened is that information came out about severe escalation in the tariffs and general trade war between the US and China. Now, obviously the two. So I'll be speaking about these two stories together. Obviously, first of all, I'm going to be talking about the trade tensions and really the trade war that's been going on. But I'll also be talking with a bit more of a focus on later on the minutes of the meeting, because it gives a general outlook on the monetary policy and essentially what the committee is looking to do, and the kind of reassessment that they're doing of the current monetary policy, and essentially what they might do with the rates in the future, etc. So, I woke up today thinking that, like I said, it was a pretty average week without any breaking news stories in the kind of sphere of information and influence wherein this show lies. But like I said, last minute cracking news came out, so I'll get onto that in a second. Right, so what's the news and what crazy events took place in the last 36 hours? So I'm going to start this off with an article from the FT that came out just yesterday, and it showed that China has retaliated to the US with their own tariffs, so additional tariffs placed on approximately $75 billion worth of US goods. essentially US exports to China, so that is Chinese imports of the US. So essentially I'm going to be reading from the article now. China has announced that it will apply additional tariffs of between 5 and 10% on $75 billion worth of US imports from September, marking the latest escalation in an increasingly bitter trade war between the world's two largest economies. Very interesting. I'm going to actually tell you some specifics of the tariff. So China has also imposed a tariffs on US-produced crude oil for the first time. In fact, I actually just accidentally skipped some stuff as well. So essentially crude oil, that's one big kind of tariff that everyone's been talking about, latest tariff. Beijing will also add tariffs on imports to a list of products including frozen pork and nuts from 1st of September, and on a separate set of products including some kind of fabrics and food flavorings from December 15th. The finance ministry said on its website. So essentially a wide array of different tariffs. One of the main ones obviously being the crude oil, and essentially yellow soybeans as one of the main US exports to China, so that is Chinese imports of the US, will be hit with a further 5% duty, that is a tariff, from September that adds to a 25% tariff imposed last year. So obviously, first of all, there's new tariffs. There's therefore also escalations on current tariffs. And what the article says here, actually, what I'm going to pick up on is it was the latest trade war escalation. Well, Trump replied very hastily to their kind of, not threats, but quite literally tariffs. And essentially, I'll go into that in just a second. I'm going to talk more about the US crude oil and essentially talk about the fall in, obviously, demand that this may pose. Crude oil actually fell in price. I believe it mentions it here. So Brent crude, the international oil benchmark, fell 1% to settle at a 59.34 barrel immediately. So obviously that is in response to the tariffs and what this might mean for the kind of demand for US crude oil. Essentially what tariffs may do, and this kind of protectionist policies, what they aim to do is to switch consumer behavior from foreign goods to domestic goods, or at least from that which has a tariff imposed on it. So instead of US crude oil, though, they might Chinese consumers of crude oil will now switch to a different producer, whether it's going to be whatever place in the world. It's just essentially switch from the US to another place. And just to kind of round off this point of US crude oil imports to China, we can see this graph here, which essentially shows that for the past few months, the imports have averaged. I mean, the peak here is just over 200,000 barrels per day. It was at a low of about 200,000 again, 140,000. So for the past 4 months, there's obviously been a large inflow of US crude oil to China, meaning that with a certain tax on this, it will definitely sway the kind of the trade flow and will firstly obviously increase the price of the crude oil and from the US, and as a result might cause Chinese consumers to switch. Right, so I'm going to move on to the second news story right now, and that's essentially Trump's response, which this article came out literally 12 hours ago. So right now it's 12 p.m. here now in Poland. So this came out midnight last night here. So I don't know what time that might be in the east and west coasts of the US. But the point being that the market still had time to react. So essentially, like I was talking about the indices going down a few percentage points. I've actually got the S&P 500 up here. Even on Google, it doesn't really matter. You can see that most of the losses were actually carried on the Friday. That is obviously in response to what China hasn't planned. They're also I believe that they also introduced a new interest rate within their economy. So obviously they're boosting their own economy. They're hurting or retaliating to US's or Trump's actions. But in response to this, and that's kind of just the bread and butter, meat and potatoes of this whole show segment, whatever, is the fact that Donald Trump retaliated. As you can see, this article by the FT came out just 12 hours ago. So that's midnight last night here in Poland, so I don't know what time it was in the US east and west coasts, but as the article mentions here, in a series of tweets, of course, after the stock market closed, actually. So, oh wow, okay, so these losses that I just talked about are in the indices, which were 3%, were just in response to China. So we'll see exactly what happens next week when markets and just about any financial instrument has time to react to Trump's retaliation, because it's going to be very grim. I actually, until now, I was mistaken. I thought that these markets had already reacted to Trump, but I was wrong. In fact, he was definitely waiting until the stock markets closed to announce the tariffs through a series of tweets. I really do believe this is highly kind of planned and intentional. Anyways, that doesn't matter as much as what he actually did not, So essentially, he's raising existing tariffs on 250 billion worth of Chinese goods from Chinese imports, from 25% to 30% on October 1st, and raising tariffs on 300 billion US dollars of Chinese goods due to start from the 1st of September, so that's just in a week, from 10% to 15%. So as you can see, with China's kind of retaliation aiming, kind of targeting 75 billion US dollars worth of goods, this is a very strong retaliation in the sense of magnitude. There's essentially been 5% increases on both sides here of the Chinese imports on two types of goods. But essentially, what this kind of shows is that this isn't, like a trade dispute. There's, the two sides won't be debating or negotiating too much from this point. This has genuinely turned into a crazy trade war. I mean, if you think about it, Trump took just a day to respond to China. So you can argue, I mean, to what extent is this a calculated move as much, as it, in my opinion, is just a political, pushback, it's an economic pushback on what China has imposed. It's a genuine trade war, One side imposes tariffs, so Trump imposed tariffs like a few weeks ago. China's responded, they devalued their currency. They've now added more levies onto US goods, crude oil amongst others. And now the US has responded again in very quick succession. So like I said, these are very severe escalation in the trade war now, really. You can argue, I mean, like I said, to what extent is this all calculated as much as it is just a quick pushback, quick pressure? Because I think I actually mentioned this last week. China cannot defeat the US on tariffs. I believe there's a lot more Chinese imports to the US than there is US imports to China, such that Trump has got more leverage in using tariffs. But again, it's not to say that they're going to win the trade war, because in a war like this, there's really no clear winners. Trump has often said he's the chosen one in a sense to defeat China on their unfair practices and unfair kind of competition. And you can have a stance on this, that's just based on opinion, but the fact is right now that there's been crazy escalations in tariffs, including the creation of new tariffs and adding new tariffs from both sides of the aisle. And what that's going to do is essentially potentially lead us to the next global downturn in economic activity, as it has been for a while now. I think since this started, it's been about a year or two, somewhere around that time. And since then, global trade obviously has stagnated. I remember at university, I actually made a video on this. I was talking about the trade war and the trade tensions. And this was, I think, somewhere around 9 months ago. And even then, global trade had stagnated. I'm sure it hasn't gotten much better since then. But we can actually read some of the comments. The rest of the article is Trump's tweets, all that kind of stuff. I actually had a look at the comments earlier. They're obviously anti-Trump. A lot of people don't agree with what he's been doing. So, in this escalation and the trade war, and people often try and negotiate certain deals. However, that's not what Trump is doing at the moment. Neither is China. So I'll read one specific comment, if it is from this article, because I think I had a look at it a second ago. Right, so the actual comment that I found is from the previous article, so that's to China to hit the 75 billion US dollars worth of goods. Essentially, what the comment reads is, this is meaningful. China's calculus has changed. China states it does this in reaction to the threat of tariffs, not as previously in a tit-for-tat response to actual tariffs. This probably means a few things. One, they have already addressed the fallout from these tariffs, so that is obviously in response to Trump's earlier tariffs a week or two ago, wherein China devalued their currency and now has started to stimulate their own economy from the ground up, introduction of new interest rates. Two, they no longer believe there is much point in constructive negotiations with US counterparts. This is actually something I really agree with, especially with Trump's quick response right now. you can see that the two sides are going to have some trouble coming to, some kind of negotiation and, kind of any positive result that can help long-term economic growth. And amidst this kind of economic environment, it's really sad to see this. They sense weakness in Trump. Yeah, I don't know what to comment on that. That's obviously more political than economic. And as much as I love discussing politics, I wouldn't say I can say that whether I can see weakness or not in Trump. His response doesn't, it's a pretty strong response in the sense that he has placed tariffs or essentially increased tariffs on a lot of Chinese goods. I'm not sure if that's a weakness or not. Maybe it is, maybe it isn't. Again, that's more of an opinion, I think, on politics than it is what's happening in the economy and worldwide economy. I got that right this time. Anyways, I'm actually going to go back to the second article that I was just reading. We scanned across a tweet very quickly, and that's going to perfectly lead me on to the second kind of news story, which, like I said, is very integrated with the first, and it was meant to be the first until just a few hours ago. So Trump writes in the tweet, this is on the 23rd of August, so that was just yesterday. As usual, the Fed did nothing. It is incredible that they can speak, in quotation marks, without knowing or asking what I am doing, which will be announced shortly. We have a very strong dollar and a very weak Fed. I will work brilliantly, in quotation marks, with both and the US will do great. With both and the US will do great. Right, so, his tweets are pretty funny. It is incredible that they can speak without knowing or asking. Yeah, they're an independent. It's a central bank. They're independent for a reason. Obviously, communication always aids in kind of more progressive or kind of succinct planning of economic tools. Management of economic tools. But essentially, they're an independent committee. The reason for that is obviously to not be influenced by a president or strong-handed or strong-armed or whatever the saying is in any sort of way. Anyways, I think that's also what moved the markets yesterday. Like I showed on the S&P 500, there was a big drop, and obviously in many other indices. So obviously people were expecting Trump to do something in response to China, and so he did. The markets are going to really respond to that later this week, and I think if anyone has been selling their stocks in the past week or two, you might have just sold at the peak for the next period of time. Anyways, what does this mean? The Fed did nothing. Well, the Fed recently had the minutes of the meetings posted, and essentially the main kind of takeaway that I took from reading the kind of minutes is that the Fed's latest rate cut was actually, as they said, a recalibration. It wasn't there to pave a path for future kind of rate cuts, as some people suggested or some people want, amongst Trump amongst others. But essentially, it was to do with risk management in the sense of there was falling business investment, as the article reads. There was slowing economic activity, manufacturing. So it was a tool of risk management in the sense that, like they said, it was a recalibration. It's not something that they'll continue to do, even though some people speculate they will in the future. However, it just breeds more uncertainty. There's more uncertainty by the day. And what I kind of have been thinking about lately, and the question that I want to pose that you might need to think about is, as Trump wants the Fed to do, or as a lot of people want the Fed to do, cut rates, to what extent can interest rates, truly counteract the effects of such a crazy, large in magnitude and, literally dollars of economic activity hurt through the trade war? So obviously interest rates in theory, if they're cut, they help in borrowing, business investment. They aim to increase consumer spending, since saving is a bit less appealing to some people. But the interest rates are already very low. They were recently cut from 2.5 to 2.25%. That's obviously, you can't go below zero, since there's only so far you can pull the lever of interest rates down before it becomes kind of inefficient or completely ineffective in doing anything. So obviously quantitative easing and different expansionary monetary policies obviously are a great economic tool to use to guide the economy long term, all that kind of stuff. But at this moment, to what extent do people expect this to counteract a trade war? I mean, in my opinion, it hasn't got too much fighting power in offsetting all this trade tension and uncertainty, first of all. Because, okay, yeah, in just pure numbers, if you cut the interest rates, some people will definitely find it more appealing to invest in their business and borrow, that kind of stuff. But it doesn't really target people's sentiment about the economy. It doesn't impact the producer confidence. I believe that there's a bunch of metrics which look at the kind of confidence and sentiment of businesses, obviously of consumers, of various economic agents in whatever economic activities they may be doing. So obviously consumer index in the sense of consumer confidence, business confidence. And one of the indices that I was just referring to essentially is that of the kind of senior management and managers' role in their oversight of the business. How confident are they in conducting business in this environment? How confident are they in producing goods? And really just the kind of main question here is, are interest rate cuts actually going to impact that enough to sustain our economy through the one of the longest bull runs that it's ever had, or at least in very recent history, obviously. And personally, I don't think so. I think you can't just use regular monetary policy, interest rate up, down. You need to tackle some regulations. You might need to look at fiscal policy, supply side policy, whatever it might be. Actually, that's what Trump is doing recently. It's more obviously political. Actually, maybe not, but essentially he's planning more tax rate cuts in the economy. He's looking at actually one of the biggest news in the week, also from a more political standpoint, was the deregulations in the economy. So obviously people on the right economically are going to really like that. There's less regulation, there's less hassle, more freedom in doing business. Whether that is good or bad, that is up for discussion. However, that's what's been happening. So obviously Trump personally is trying to tackle this trade war through deregulations and improving business confidence actually in doing business, or people's confidence in doing business. But like I said, interest rates by itself are definitely not enough. And I think there's actually a quick commentary on this in the article. I can't find a specific comment now, but it was essentially a comment from the FOMC, Federal Open Market Committee, kind of being skeptical of, at this point, especially with this escalation of the trade war, there being kind of skepticism about how much can the interest rates really help. And even though Trump is shouting from one side, analysts are speculating and shouting from the other side. In the end, interest rates can only help so much. So guys, thank you for watching. This has been World Wild Economy. I believe episode 4 this week has been crazy, and it'll be interesting to see how the markets react Monday morning. You're going to be drinking your coffee, and I imagine stocks are going to be falling in price. Anyways, if you have enjoyed this, please do check out some articles that I've posted on investingintellect.com. Remember to stay tuned for the video that I'm going to be posting on the McKinsey study with some analysis on the actual study, see what's going on in Asian financial markets. I hope you've enjoyed the video podcast, and I'll see you next week.